Hi there. Today we'll explain how whole-of-life and Gift Inter Vivos insurance differ, helping you understand important inheritance tax planning decisions in the UK.
Imagine you've spent 3 decades building a successful UK business. You decide it's time to step back, handing over a substantial block of shares to your children to secure the company's future. Then, a sudden health event occurs. Because you passed away within 7 years of that transfer, HMRC assesses a massive 40% inheritance tax bill on the gift. Without the liquid cash to pay it, your children are forced to liquidate the very company you intended them to run. Welcome to Pro Tax Accountant. Today we are decoding the strict premium maths of inheritance tax insurance and showing you how to prevent this exact scenario. The dilemma comes down to 2 very distinct tax vulnerabilities. First, transferring assets via a lifetime gift creates a temporary 7-year period where those assets are fully exposed to inheritance tax. Conversely, holding on to a business, property, or large pension until you die creates a permanent 40% tax liability on your estate. You have to match the specific type of liability, temporary or permanent, with the exact actuarial insurance structure. Getting this wrong guarantees thousands of pounds in wasted premiums and a massive erosion of your family's wealth. Let's start with the temporary threat. Suppose you gift shares or property that exceed your standard £325,000 nil rate band allowance. Under UK tax law, this is classified as a potentially exempt transfer. It means the recipient faces a direct 40% tax liability if you die within the next 7 years. To see how that tax burden behaves, we can look at this chart mapping statutory taper relief. For the first 3 years, the liability sits at a flat 100% of the tax due, but at year 4, the tax bill steps down by 20% each year, eventually hitting 0 at year 7. To cover this efficiently, we use a Gift Inter Vivos, or GIV, insurance structure. This utilizes 5 separate overlapping policies. They are mathematically designed to expire at the exact moment the tax liability steps down. This creates incredible financial leverage. A potential £900,000 tax liability can be fully covered for those 7 years at a total premium cost of roughly £4,500. Because the insurance perfectly mirrors the dropping tax bill, a GIE policy ensures you only pay for the exact decreasing risk you hold. For gifts above your allowance, it is the only mathematically optimized tool. Now we look at a highly common variation, making a lifetime gift that falls completely under your £325,000 allowance. The gift itself incurs 0 tax, but it entirely consumes your nil rate band for the next 7 years. Look at what happens to the residual estate. The protective container of the allowance is emptied by the gift, instantly exposing the remaining estate to a flat 40% tax from the very first pound. If you buy a decreasing GIV policy here, it is mathematically useless. The estate's tax liability remains completely flat, but the insurance payout drops, creating a dangerous coverage gap. The correct solution for this scenario is a 7-year level term policy. The flat coverage matches the flat vulnerability of the estate. Misdiagnosing whether your gift sits inside or outside the nil rate band results in buying the wrong architecture.
It leaves your family catastrophically underinsured. Let's pivot to the second category, permanent liabilities. This occurs when you retain ownership of a business, investment portfolio, or a large pension until you pass away. Retaining those assets generates a permanent, unavoidable 40% inheritance tax bill, which typically comes due upon the second death of a married couple. Because death is a certainty, temporary term policies won't work. The required tool here is a whole-of-life policy, which requires a permanent monthly premium but guarantees a tax-free payout whenever death occurs. To test the efficiency of this side-by-side chart compares a whole-of-life policy against a strategy of self-insuring. We are matching a £900 monthly insurance premium against investing that exact £900 into a 3% growth portfolio. The whole-of-life strategy instantly locks in a guaranteed £500,000 tax-free payout from day 1. Meanwhile, the investment portfolio slowly creeps upward over years and decades. If death occurs at year 17, the investment strategy, after estate taxes are applied, leaves the family with just £143,000. That exposes a massive £356,000 variance in family wealth. While whole of life requires consistent cash flow, The math proves it completely eliminates market timing risk. It vastly outperforms attempting to self-insure a permanent tax liability. Every calculation we've discussed relies on one mandatory legal step: placing these insurance policies into a discretionary trust. If you leave the policy in your own name, the insurance payout gets added back into your taxable estate. HMRC will take 40% of the payout value before your family sees a penny, defeating the purpose of the insurance entirely. To fund these policies efficiently, premiums should be paid using the normal expenditure out of income exemption. This ensures your monthly payments aren't classified as further taxable gifts. The most perfect mathematical insurance structure is rendered completely useless without the correct legal setup and strict compliance records. UK inheritance tax mitigation is an exact actuarial science. It is not a guessing game of random life insurance policies. Let's review the rules. If your target goal is transferring shares or making gifts, you create a temporary risk. You must use either decreasing Gift Inter Vivos or level term policies, dictated purely by your nil rate band allowance. If your goal is holding businesses or pensions, you create a permanent risk. You must secure the guaranteed liquidity of a whole-of-life policy. Do not let 30 years of building a business be eroded by 40%, simply because of unoptimized estate planning. Please note, the information provided here is based on current 2026 HMRC legislation and does not constitute formal financial or legal advice. To protect your legacy with a bespoke tax strategy, reach out to the experts at Pro Tax Accountant. We can build the exact mathematical architecture your estate requires. Contact us today using the details on screen and subscribe to the Pro Tax Accountant channel for more definitive guides on navigating UK tax law.